Hey everyone, welcome back to the deep dive. Today we're really getting into something important for a lot of you, especially if you're over 60, Roth IRA conversions. Now, this can sound like a really dense topic, right? But our mission is to kind of cut through the jargon, give you those clear insights, those aha moments, make you feel truly informed about whether this move might be right for your financial future. So you've maybe hit that milestone, maybe you're 60 or even 70, and you're probably wondering, is it too late? Should I even think about converting my traditional IRA to a Roth? Isn't that just for younger folks? It's a really common question, and honestly, the answer might surprise you. Okay, let's break this down.
It's definitely true. Traditional IRAs have been around much longer, so they're often what older savers are more familiar with, maybe more comfortable with. But the Roth conversion, it offers some really distinct and often overlooked advantages, especially for those nearing or actually in retirement.
Mm-hmm.
We're going to walk you through the big benefits, but also, crucially, the considerations, like the tax implications. That's what makes this decision challenging, but also potentially very rewarding.
Right.
The core idea. Why convert after 60? And why not?
All right, so if someone over 60 is even thinking about this, what are the immediate, like the big picture pros and cons they need to weigh right off the bat?
Okay, on the positive side, converting a traditional IRA to a Roth at this stage, well, it can provide some really powerful benefits. Think about tax-free withdrawals in retirement. I mean, truly tax-free, which is huge. Then there's the incredible advantage of leaving a tax-free inheritance for your beneficiaries. That simplifies things a lot for them. And a big one for many. No required minimum distributions, RMDs, from that Roth account once it's established, not for the original owner anyway. All of these contribute to greater tax diversification and can really streamline your estate planning later on. The main hurdle, though, and it's a big one, is the immediate cost. You have to pay income taxes on the amount you convert, today's taxes. And for larger balances, that initial tax bill can be quite significant. Plus, you have less time for those converted funds to benefit from tax-free growth compared to someone who converted, say, in their 30s or 40s.
Right, that immediate tax hit. That often leads to the next question people ask. Are there any rules that would stop an older saver, say someone who's 73, from even doing this conversion? Like an age limit or an income cap?
That's a great question, and it's actually a common misconception. There is no age limit, none at all, and no income requirement to convert a traditional IRA to a Roth.
No income limit? Really?
Well, not for the conversion itself. So yes, someone age 73 can absolutely still roll over funds. Just remember, you pay taxes on the pre-tax amount converted. Now, if you made any non-deductible contributions to your traditional IRA over the years, that part would convert tax-free. But once the money is in the Roth, your original contributions can always be withdrawn tax-free. The important thing to watch, though, is the earnings.
The 5-year rule.
Exactly. For the earnings on that converted money to be withdrawn completely tax-free and penalty-free, the account needs to have been open for at least 5 tax years, and you generally need to be age 59 and a half or older. That 5-year clock starts on January 1st of the year. You make your first Roth contribution or conversion. It can be a bit tricky for people new to Roths, too. Here's where it gets really interesting. The ripple effects of a conversion.
Okay, so this isn't just, moving money from bucket A to bucket B. A Roth conversion can send these ripples through your whole financial picture in ways you might not expect. What's the biggest ripple effect we should probably look at first?
That's it, exactly. Any amount you convert to a Roth is included in your adjusted gross income, or AGI, for that year. Your AGI, that's basically your gross income minus certain deductions. It's a key number the IRS uses for lots of things, including your tax bracket.
Right.
So, obviously, a big conversion can push you into a higher tax bracket for that year, but it doesn't stop there. That higher AGI can have very specific impacts on your Social Security benefits, and maybe most importantly for this age group, your Medicare premiums.
Yeah.
Impact on Social Security and Medicare premiums.
Okay, let's drill down on that AGI impact then. How exactly does bumping up your AGI just from moving money between retirement accounts start messing with something like Social Security benefits, especially if you're already receiving them?
Yeah, this is where it gets really strategic, or maybe a bit complex. The Social Security Administration, and Medicare too, they determine your premiums, specifically something called the Income-Related Monthly Adjustment Amount, or IRMAA,
IRMMEA.
based
Yeah.
on the income you reported 2 full years earlier. It's a 2-year look back.
2 years. Okay.
Yes. So, for example, if you do a big Roth conversion this year, let's say 2023, that increase in your AGI won't affect your Medicare premiums until 2025. But in 2025, it could potentially trigger higher Medicare premiums, those IRA surcharges, and it could also increase the portion of your Social Security benefits that become subject to income tax.
Wow.
The real aha moment for many is realizing you're kind of playing a longer game with your income reporting,
Yeah.
not just thinking about the immediate tax bill from the conversion.
Yeah.
It's why careful planning, maybe spreading conversions out, is so important.
That 2-year look back is a huge detail. So sticking with the Medicare side for a second, what are the kinds of income thresholds and potential surcharges people should be aware of? Generally speaking, of course, because the numbers change.
Absolutely, the numbers are indexed for inflation. But just to give you an idea, using the 2025 figures as an example, if your modified adjusted gross income, which is AGI plus tax-exempt interest, goes above certain thresholds. For 2025, that's around $106,000 if you're single, or $212,000 if you're married, filing jointly. Then you start facing these Medicare high-income surcharges for both Part B, which is medical insurance, and Part D, prescription drug coverage.
And these surcharges aren't trivial, I assume.
Oh, definitely not. They mean significant additional monthly costs on top of your standard premiums. To give you a sense of the scale for 2025, for Part B, these surcharges could add anywhere from, say, roughly $74 to over $440 per person each month. That's on top of the basic 2025 premium, which is expected to be around $185.
Wow, per person.
Per person, per month. And for Part D prescription drug coverage, the surcharge can add an extra, let's see, around $14 up to maybe $86 a month, again, on top of whatever your specific plan premium is. The base Part D premium is projected at about $36 for 2025. So, your total monthly Part B could jump from around $259 up to nearly $630, and Part D from about $60 up to over $130. These can be really substantial amounts, and they often catch people completely by surprise if they do a large conversion without factoring in this 2-year look-back effect. It's not just the income tax and the conversion itself. B, navigating required minimum distributions, RMDs.
Okay, shifting gears slightly but still related, RMDs, required minimum distributions. For many older savers, that's a constant calculation, a constant tax consideration. How does doing a Roth conversion fit into that picture? Can it actually help manage RMDs, or does it just add another layer, especially if you're already past the RMD starting age, currently 73?
This is actually one of the key strategic benefits for many people considering a conversion later in life. Now, if you convert after you're already subject to RMDs, so after age 73, generally doing the conversion won't reduce your RMD for the current year.
Okay, that's important.
Right, because that year's RMD is always calculated based on your traditional IRA balance as of December 31st of the previous year. The conversion happens this year. However, here's the good news. It will reduce your RMDs in all future years. Why? Because those funds you converted are now out of the traditional IRA, which is subject to RMDs, and safely inside your Roth IRA. And Roth IRAs have no RMDs for the original owner.
Okay. So it helps going forward.
Precisely. It shrinks the pool of money that future RMDs will be calculated on. And this is exactly why many savvy individuals or their advisors recommend a strategy of maybe rolling over just a portion of their traditional IRA to a Roth each year.
Instead of one big lump sum conversion.
Exactly. Doing partial conversions over several years allows you to carefully manage your taxable income each year. You can try to stay below those Medicare IRA thresholds we just talked about, control which tax bracket you land in, and maybe avoid bumping up the taxability of your Social Security too much. It's about optimizing your tax picture over the long haul, not just getting hit with one massive tax bill and potential surcharges. Gradual conversion can be much smoother. 3. So, what does this all mean? Is a Roth conversion after 60 right for you?
Okay, wow. We've covered a lot of ground here. The big picture benefits like tax-free withdrawals, no RMDs, estate planning, but also these really intricate ripple effects on AGI, taxes, Social Security, Medicare. So let's try to bring it all together. For our listener who's over 60, maybe in their late 60s or 70s, and they're weighing this decision, when does it generally make sense, and when might it be, maybe not the best idea?
Fundamentally, it often boils down to taxes now versus later. If you're over 60 and you anticipate that your tax rates in retirement will likely be higher than your current tax rate.
Which could happen if tax laws change, or maybe their income goes up unexpectedly.
Exactly. Or maybe they have large traditional IRA balances that will push them into higher brackets via RMDs later. If you expect higher taxes ahead, paying the tax now via conversion at today's potentially lower rate can be a very smart move.
Yeah.
Also, if eliminating future RMDs is a really high priority for you, maybe for required minimum distribution planning itself, or simplifying things, or for estate planning purposes, then a conversion is a strong contender. And remember that key point. No earned income is required to do a conversion. So yes, a 73-year-old retiree can absolutely still do this. That opens the door for many people. On the flip side, though, if your current funds are tight and paying that immediate income tax bill on the conversion would create a real financial strain, maybe forcing you to sell other investments you didn't want to sell.
Or even take money out of the IRA to pay the tax on the conversion, which is usually not ideal.
Right? That's generally inefficient. So if the tax bill is a burden, maybe hold off. Also, if you genuinely expect your personal tax rates to decrease significantly in the future, maybe you anticipate much lower income, then paying tax now might not be optimal.
So the big takeaway here really seems to be it's powerful, but it's definitely not a simple yes or no. It's very personal.
Precisely. It's not a one-size-fits-all solution.
Yeah.
That's why when you're evaluating your personal goals, your current financial situation, your health, your longevity expectations, your estate plans, and your long-term tax outlook,
Yeah.
well, having a detailed conversation with a qualified, experienced financial advisor or tax professional is really essential. They can help run the numbers, model different scenarios, and help you navigate these nuances to make the most informed decision tailored specifically for you.
So we've taken a really deep dive today into Roth IRA conversions for older savers. We explored those compelling benefits, the tax-free withdrawals, the estate planning advantages. But we also really laid bare the critical considerations that immediate tax costs, those potentially surprising Medicare surcharges, the Social Security impacts. It's complex stuff.
And we've seen how carefully planning your conversion, maybe thinking about those strategic annual partial rollovers, can really help manage those potential financial consequences. It turns what seems like a complex decision into more of a thoughtful, long-term strategy.
What an incredibly insightful conversation. We really hope this deep dive has given you, our listener, a much clearer picture and those crucial nuggets of knowledge to feel truly well-informed about this option.
Definitely. But as you reflect on all this, maybe consider this provocative thought. How might truly understanding these intricate connections between your IRA choices, your future taxes, your Social Security, your Medicare costs, how might that lead you to rethink not just your retirement savings strategy, but maybe your entire financial planning approach for the decades still ahead? It really encourages you to see the whole financial chessboard, doesn't it? Not just the single move right in front of you.